Hey everyone, I'm going to share with you my top 9 growth stocks to buy in June 2024. I've been sharing with you my list of top stocks to buy every month for the year of 2024 and also sharing with you how my picks have performed. And I'll give you a hint, my top stocks to buy have performed very well against the broader market ETFs. They continued that outperformance here in May and as of year to date in 2024. So let me share with you what my favorite stocks are to buy right now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, here is my list of top growth stocks to buy right now. Here's 8 of them. I'm going to share with you one of them a little bit later. The reason I'm going to share one a little later is because I only added that last one a couple of months ago. So here's my list. Nvidia, of course, is not my favorite stock to buy, surprisingly, but it is one of my favorite growth stocks, one of my top 10 growth stocks to buy. It's up 121% year to date in 2024. I've had Nvidia stock on my list all year long, given the benefits it's receiving from the rising effectiveness of artificial intelligence and its position in that industry. Nvidia has benefited from surging revenue, profits, and cash flow. It's been tangible results. It hasn't been just hype for Nvidia. It's been growth in all of those key financial metrics, and that's why I've liked Nvidia stock all year now. Amazon, the next one on my list, is up 16% so far year to date in 2024. Amazon too has done a great job boosting revenue, profits, and cash flow despite rising competitive pressure. Amazon is also benefiting from the rising effectiveness of artificial intelligence. Its cloud segment is re-accelerating growth. Amazon is growing its advertising business by more than 20% year over year every quarter for the last several quarters, and the company has grown into those investments it made in 2020 and 2021. Snap, the next one on my list, so far year to date is down 11%. The company now benefiting from the growth in advertising spending and an adjustment it made to adjust for the changes that Apple made in making it difficult for Snap to collect user data. Snap adjusted now and is accelerating growth, and I think it's on the right path forward. Fiverr is down 7% year to date. Fiverr is an Israeli-based business, so the war in the region has not helped. Also, the company is suffering from a slowing growth rate, but Fiverr's stock is ridiculously cheap, and that's why I like that gig economy stock. PayPal is up 2.59% year to date. PayPal recently upgraded its earnings per share outlook for 2024. That has boosted the stock's price somewhat, but it's still very cheap according to its prospects in my view. Salesforce recently reported disappointing earnings results that sent the stock price down as much as 16%. I reviewed those earnings results and I reiterated my recommendation for Salesforce stock. I still think it's a top growth stock to buy right now. Uber Technologies is up 4.84% year to date. Uber is benefiting from that away from home trend. People want to get out of their house and spend more time away from home. But surprisingly, Uber's food delivery business continues to thrive even amid that away from home trend. I've been blown away by Uber's ability to drive both parts of its business and allowing that to boost cash flow from operations. I've been pleasantly surprised with Uber and one of the more capable management teams in the world today. And finally, Alphabet is up 23.44% year to date. Alphabet, you may have already seen, is also my top stock to buy in 2024, as well as being on my list of top growth stocks to buy. Alphabet's competitive advantages, lucrative profitability, and a massive $1 trillion advertising market opportunity, along with its cheap valuation, has brought it into my list of top stocks to buy. Now, the one stock that I didn't mention so far is Chewy. Chewy's the last one on my list of top growth stocks to buy. I recently only added Chewy about 2 months ago. I believe it was at the beginning of March that I added Chewy to my list of top growth stocks to buy. Chewy came in and it replaced Zoom. I had Zoom on my list of top growth stocks to buy, and I took Zoom out and I replaced it with Chewy. Another stock that I have taken out of my list of top stocks to buy is Fortinet. Fortinet was previously on my list. I took Fortinet off of my list because of the rising competitive pressure in the cybersecurity industry implemented and the slowdown in billings growth demonstrated by Palo Alto Networks in its most recent 2 quarters. Now you'll see the forward price to earnings ratios are not expensive at all. The most expensive stock I have here is a forward PE of 35 for Snap. The next most expensive is Nvidia at a forward PE of 31. And then I've got some really cheap stocks here, Fiverr and PayPal, trading at forward price to earnings ratios of 10 and 13.8 respectively. And overall, as a group, I think these stocks are trading relatively inexpensively given their prospects, given their profitability. And I think they make excellent investments. And I've thought they've made excellent investments all year long. Now, I highlighted that I only recently added Chewy to my list. I added it to the list in March. And for the first month and a half, it didn't look like a good pick. The stock was down almost 20% since I recommended it in early March. And then, of course, you probably saw Chewy reported an excellent earnings result, and that sent the stock price up by as much as 30%. And you can see that big jump here. It's now up 17.75% since I made the recommendation in March. So Chewy's been one of my better winners now, given the recent quarterly update. Now, if you compare my portfolio of stocks to the S&P ETF, it has returned 11.23%, but the equal weight S&P 500 ETF has returned 5.47%. So I'm going to compare my performance against these two indexes, against the equal weight ETF and the S&P 500 ETF. Now, if you're measuring on a like-for-like basis, the equal weight ETF is the better one to compare with because all of my stocks, I give them equal weight in the return calculation. I calculate them on an equal weight basis, not on a market cap basis. So that's the one I recommend comparing to, but you're free to compare as you wish. Here we go. So here is my portfolio return. My portfolio return is up 15.755% year to date, and the S&P 500 is up 11.23%, but the equal weight portfolio is up just 5.47%. So my group of stock picks is almost tripling the return of the equal weight portfolio. So a strong outperformance to be sure. The prime contributor, of course, is Nvidia to that return, generating 121% of that return. Overall, the majority of the stocks have been positive, only 1, 2, 3 negatives out of the portfolio, and the rest are positive, 1, 2, 3, 4, 5, 6, 7 positive out of the portfolio. It's becoming more difficult to track my results now because of the additions and subtractions from the portfolio. I've highlighted that I took out Fortinet from this portfolio. I've still accounted for it in this results, even though I took it out because it was in my portfolio for most of the year. So I'm still accounting for it in these results. Fortinet is up 0.48%. From the beginning of the year until the time I took it out of my portfolio. But as I was saying, it's becoming more difficult to track my results because of the additions and subtractions. Chewy's only been in my portfolio for 2 months, while Nvidia's been in my portfolio all year. Do they deserve a different weighting? You could argue, yes, they do. How should I distribute that? And then you've had the ones that I've removed, like Fortinet, Zoom Video, and the ones that I've added. So it's becoming more complicated. I'll try to do my best to keep you updated on how my portfolio is performing, but please forgive me if these portfolio returns, if I start to de-emphasize these comparisons, even though they do present as if I'm outperforming. You can compare it and say my picks are outperforming the S&P 500 index. I have been cautioning investors not to look at that and say that my picks are going to continue outperforming the index. I think this outperformance is going to revert back to the mean. I don't think I'm going to consistently outperform the S&P 500 or the S&P 500 equal weight ETF by this large of a margin. I just think the factors have worked in my favor so far this year, and I don't think that the factors will always work in my favor as strongly as they have so far. It's nice that they have, and I'm happy for those of you that have followed some of these picks and made some money on these. And I own some of the stocks that I'm recommending here, so I've made some money on them as well. So it's all great, but I'm not expecting this kind of outperformance to continue. That would be unrealistic. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.